Hello and welcome back to All Things Money. I'm your host for the show, David Blain. Thank you for joining us during the second segment this week. We're going to devote the whole show today to the housing market. So if you missed the first segment, we had a good introduction into what's going on in the housing market. Going over to the web, dlblain.com. Our archive will be posted in about a week or so. But we've got a lot of material to cover, so I'm going to keep moving here. We were talking about some valuation measures, looking at price to income ratios. This is where we look at the price of housing versus the median. So the median housing price versus the median income. And this is a good way of sort of looking at the affordability of homes. And we see that the average since about 1982 has been about 3 times income. So if you make, if the median family income was $50,000, the median home price is about $150,000. And we see that during the bubble in 2005, 2006, this ratio got up to almost 4 times, which is a 2 standard deviation event. If there's anything to define a bubble, it's when something moves 2 standard deviations beyond its mean is generally considered some sort of a bubble. So we see that ratio now actually has dropped back below the median, is about 2.7 times. Another way to look at it is what we call the financial obligations ratio. We see that the overall financial obligation ratio, which is vehicle leases, rent, insurance, property tax, things like that, has dropped to 16% from a peak of around 18% or so. We see that the homeowner financial obligation ratio has declined to a normal rate of 14.4. Renter obligation ratio has declined to about 24%. And so we see the debt service ratio down to 11%, which is also once again in the normal range. So on a price to income basis, we're seeing these valuations drop back to a normal type valuation. Same thing for price to rent. We see that the home prices have been, the rate of appreciation in rent has actually exceeded the rate of price appreciation for homes. We see that the rents are rising faster than home prices. And typically when you see this, it marks a low, that people start moving away from houses and the demand for rent goes up. And when it becomes no longer profitable to own a home, people start moving towards rent. Well, some of those ratios have reached a point where typically they would signal some sort of a low point. Even if we look at with housing or cars or anything, you have to look at the quality of the home. And so there are some adjustments to make for the relative quality. For example, you have better windows now than you did 10 or 15 years ago. And so even on a quality adjusted basis, we see those levels returning to somewhat of a more normal level. We see that the asking price for vacant units has bottomed out and seems to be some rise to when housing units are vacant. The asking price as compared to the monthly rent, we see those beginning to be comparable again. Financing is an interesting area as well. We see that adjustable rate mortgages in September accounted for only 1% of the financing, where it had peaked out at somewhere in 2005, probably 40% of the finance. We see virtually nobody wanting adjustable rate mortgages today. In case you're wondering, the average mortgage rate people are getting is about 4.4%. The other thing that is the fees charged for the initial financings has actually gone up, and you think, well, that's a bad thing. Well, actually, it's a good thing. It shows a return to normalcy. If you go back to 2005, people could get a mortgage without paying anything. There were no fees, no charges, anything. That is typical of in a bubble era, is when you have you have free and easy money. And so in this particular case, it's nice to see the rate of fees going up a little bit, sort of paradoxically. We also look at the financing mix in terms of where people are getting their money. We see conventional financing dropping down to about 60% of financing. back to levels back in the 90s. It had gotten up to the 90 percentile range. We see FHA insured housing back up to about 21% of financing. We see VA financing spiking up to about 11%. Most importantly, we see cash financing back up to almost 8% of the homes purchased. So all these type things, the fees on mortgages, the types of financing, the number of people that are using these type of financing are all going back to normal levels, which is a good sign. Another valuation measure we look at is the price to replacement cost ratio, meaning what is the price of housing versus building a new one. And we see that the value of real estate is extremely low relative to its replacement cost right now. That currently used homes are selling for about 3/4 of the price of a new home, and this is the widest gap that we've seen since this particular data from the Bureau of Economic Research was started in 1968. And so we think when the excess supply of these used homes begins to drive up, you're going to see the price of housing move back to the cost of the replacement unit. So this sort of bodes well for the new housing market, that typically people are willing to pay a premium for a new home, but now the used homes are so very, very cheap that the cost of a home versus a replacement value is this gap that we really don't see very often, and in particular this statistic since they started keeping track. If we look at relatively speaking, real estate versus total assets, it's now back down into the normal level. We see the real estate is actually fairly cheap when compared to stocks, and the year-over-year changes in real estate value versus the stock market. So we see as a percentage of household it moving back to a more normal level. Well, that brings us to our next break. When we come back, we'll continue talking about the state of the real estate market. For All Things Money, I'm David Blain.